My name is Mantri.
And I'm Titus
Together, we're excited to present our long recommendation on Kinsale Capital Group, ticker KNSL.
Kinsale operates in the excess and surplus or ENS insurance market, a niche that covers complex risks traditional insurers often won't touch. As shown here, the stock currently trades around $371, and based on our analysis, we have a target price of $825, implying roughly 106% upside.
In this presentation, we'll walk through the business, industry and moat, investment thesis, valuation, catalysts and risks, and AI considerations as well. Kinsale Capital Group is a US-based specialty insurer headquartered in Richmond, Virginia, and founded in 2009. The company focuses on hard-to-place commercial risks, meaning policies that require customized underwriting and specialized expertise. This business operates exclusively in the E&S market and distributes products through a nationwide broker network, primarily serving small to mid-sized commercial clients.
Looking at historical trends, Kinsale Capital Group has been remarkably consistent, but what stands out is how growth has accelerated in the past 5 years compared to its first decade as a public company. Over the last 5 years alone, revenue has more than tripled and net income has expanded even faster, showing not just growth but efficient scaling. This acceleration reflects the strength of its lean operating model, proprietary underwriting technology, and disciplined risk selection. Together, these factors have driven sustained high returns on equity, strong profitability, and reliable cash generation, positioning Kinsale as one of the most consistently high-performing insurers in the E&S market.
The excess and surplus insurance market has expanded structurally over time, benefiting from rising catastrophe risk, litigation trends, and stricter underwriting in traditional insurance markets. Because businesses still need coverage even after being declined elsewhere, the demand for E&S providers remains resilient, which supports pricing power and long-term growth for companies like Kinsale.
Now focusing on the moat, Kinsale's advantage comes from three key areas. First is cost efficiency. Its technology-driven underwriting platform allows faster decisions and lower expenses compared to peers. Second is specialization. By focusing only on niche risks, Kinsale builds expertise and pricing discipline that general insurers struggle to replicate. Third is scale and data. As Kinsale grows, it collects more underwriting data, improving risk selection and reinforcing its competitive advantage.
From a porter's perspective, customer power is low due to specialized policies, barriers to entry are meaningful because of regulation and capital needs, and competitive rivalry exists but is limited by Kinsale's focused strategy and cost advantages. Overall, these dynamics support a widening moat. Our investment thesis is centered on the market undervaluing Kinsale's long-term growth and competitive positioning. We highlight three core ideas. First, Kinsale's intrinsic value is supported by durable profitability, high ROEs, and a multi-decade runway in the E&S market. Second, the market is mispricing the stock despite strong earnings growth and underwriting performance. And third, management's disciplined leadership and technology-driven platform position the company to expand into high-quality specialty lines.
Taken together, we see Kinsale as a high-quality compounder trading below its long-term potential. For long-term valuation, we use the NAIC Stock Selection Guide methodology, which is a structured framework that projects future earnings, estimates potential price ranges, and evaluates risk versus reward based on historical performance. NAIC relies on a few key formulas: projecting future EPS using growth assumptions, applying historical PE multiples to estimate high and low prices, and calculating an upside to downside ratio to determine whether a stock falls in the buy zone. For our model, we projected earnings growth of 12%, which we believe is conservative. This estimate represents the average growth expectations from Seeking Alpha, Morningstar, Value Line, and Zacks, rather than relying on a single optimistic forecast. We also projected a high PE ratio of 19, which is conservative compared to Kinsale's 5-year average multiple. Since the stock currently trades around a 17 PE, this suggests the market is valuing Kinsale below its historical range, meaning the stock appears to be on sale. On the downside, we projected a low price of about $280, which reflects a conservative scenario below roughly 75% of the current stock price. This gives us a realistic margin of safety without assuming extreme downside conditions. Using these assumptions, our NAIC model produces a projected high price in the mid-$700 range, an upside to downside ratio of roughly 4.3 to 1, and expected annual returns around 15 to 16% over 5 years. Overall, this reinforces our view that Kinsale offers attractive long-term risk-adjusted returns and supports our buy recommendation. To evaluate current valuation, we use a residual income model, which works especially well for insurers because free cash flow is distorted by premiums, reserves, and capital requirements. By focusing on book value, ROE, cost of equity, reserves, and capital requirements, We directly measure the economic profit Kinsale generates above its required return. Using an 8% cost of equity, a 2.5% terminal growth rate, and long-run ROE projections, the excess returns model produces an implied share price of about $394 compared to today's price of $371. That suggests modest upside based on Kinsale's consistent ability to earn returns well above its cost of capital. We then stress tested valuation with a simplified operating cash flow model. We normalize revenue growth using 2021 to 2025 trends, translate that into operating cash flow while adjusting for float and reserves, and calculate terminal value using the Gordon growth model. Discounting at 8% gives a valuation that closely aligns with the residual income estimate, confirming the result isn't driven by aggressive assumptions.
The financial analysis helps explain why both models converge. Over the past 5 years, revenue has tripled, net income has grown even faster, and EPS and book value per share have compounded steadily. Free cash flow per share has also expanded, showing strong operational leverage. And compared to sector medians, Kinsale has consistently posted higher ROE, stronger margins, and materially faster growth. Altogether, the data indicates that Kinsale is fairly valued to slightly undervalued today, with durable excess returns supporting long-term upside. Our third thesis focuses on expansion and leadership. Kinsale is moving into homeowners and specialty casualty lines that target hard-to-place residential and niche risks. These markets remain underpenetrated and offer attractive growth potential. Industry tailwinds also support expansion, including sustained hard market pricing, increasing catastrophe frequency, and rising specialty risk demand. Leadership strengthens the story. Founder and CEO Michael Cahill has held the company since his IPO, building a disciplined underwriting culture and a scalable technology-enabled platform. High institutional ownership and strong insider alignment further support long-term strategic focus and responsible governance.
Key catalysts include continued specialty line expansion, underwriting outperformance, and favorable industry pricing conditions. That said, risk still exists. Premium valuation multiples that require sustained growth, potential pricing softening, and sensitivity to catastrophe exposures.
From an ESG standpoint, Kinsale benefits from relatively small environment footprint due to its digital platform. Socially, the company plays an important role by ensuring risks that traditional carriers decline, supporting the economic activity and business resilience.
Artificial intelligence presents a meaningful opportunity for Kinsale. AI can improve underwriting precision, fraud detection, and claims efficiency, reinforcing Kinsale's existing cost and speed advantages. It also enables deeper data analysis, which can strengthen pricing and risk selection over time. While AI introduces regulatory and cybersecurity risks, Kinsale's disciplined and technology-driven culture positions it well to adopt these tools' responsibility.
In conclusion, Kinsale Capital Group stands out as the rare combination of consistent execution, accelerating financial performance, disciplined underwriting, and a valuation that remains compelling, even under conservative assumptions. With the widening competitive moat, expanding specialty line opportunities, and the ability to generate sustained excess returns, we view KNSL as a durable compounder with meaningful long-term upside. For anyone interested in diving deeper, our appendix includes a full breakdown of our residual income model, the long-term stock selection guide methodology, and the more detailed financial analysis. Overall, the evidence points to a clear takeaway. Kinsale is well positioned to continue outperforming and represents an attractive long-term investment opportunity. Thank you.